Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at HP.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions.
This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Think about the laptop you are using to listen to this right now. Or, the desktop sitting in your home office. Chances are you bought it back in 2020 or 2021 when the entire world suddenly shifted to remote work.
Yeah, exactly. You bought it, and then you just stopped thinking about it.
Right. And because of that, the entire personal computer market hit this massive, brutal slump. I mean, demand just dried up overnight.
But right now, we are sitting on the edge of a complete reversal. That device you're using is about to become obsolete.
It really is.
Companies are betting billions that you and your employer are going to be forced to buy a new one. It is a massive, almost seismic shift in the hardware space.
And the catalyst driving this is impossible to ignore.
Right. We are witnessing a definitive revenue acceleration driven entirely by what is being called the AI PC supercycle. So this isn't just a gradual economic recovery. It is a fundamental structural shift in what a computer is actually required to do.
Yeah, and HP just reported their fiscal Q2 2026 earnings, and they didn't just beat expectations. I mean, they completely shattered them.
They really did. They explicitly cited a massive surge in demand for these new AI-powered systems.
And the market response was instantaneous. The stocks surged. We are looking at a critical turning point where building hardware is suddenly highly profitable again.
Exactly.
And when you see a macroeconomic shift of that magnitude, the first question for investors isn't just how high the stock can go, but how safe your money is while you wait for the thesis to play out.
All right, let's move into the wealth building context.
Yeah. And this is where the story gets really compelling for long-term portfolios. When you are looking for a vehicle to compound your money, you don't always want the flashiest cash-burning software startup.
No, definitely not.
Because HP is a highly mature, free cash flow machine. They generate, billions in robust cash flow that consistently funds a high single-digit dividend yield. But more importantly, they pair that dividend with a very aggressive share buyback program.
Yeah, I want to pause on that share buyback strategy because it is mathematically beautiful for protecting your downside.
Oh, absolutely. Think of a company's total earnings like a pizza. When a company is aggressively buying back its own stock and retiring those shares, they are essentially taking slices away from the total pie.
Right, the amount of pizza hasn't changed.
Exactly. But because there are fewer slices, your individual slice just got a lot bigger. So this provides an incredibly solid floor for earnings per share, or EPS. Even if the broader market hits a cyclical rough patch and overall revenue stays flat, that shrinking share count keeps the EPS growing.
It's a massive safety net, and it forces a strict discipline on capital allocation that you rarely see in the tech sector.
You really don't.
You're essentially getting paid a premium yield to wait while the AI growth story unfolds. Think of HP right now like a high-yielding toll bridge for the new artificial intelligence era.
I like that analogy.
Right. Because everyone else in the market is out there placing these wild speculative bets on cloud software startups, desperately trying to guess who the next big software winner will be. But HP is providing the mandatory physical infrastructure. If developers, creators, or enterprise workers want to build or interact with AI, they need the hardware sitting directly on their desks to do it. If you want to join the AI revolution, you have to cross the toll bridge and buy the hardware first.
Which means we need to look at how that hardware translates directly into financial performance. Now let's look at the fundamentals.
So if we dig into that Q2 2026 revenue acceleration, the absolute standout is the personal systems segment.
Right.
For years, the PC division was viewed as a mature, almost stagnant drag on the business. But today, it is definitively the vanguard of growth. And what's crucial for investors to understand is that we aren't just seeing a higher volume of units being shipped. We are seeing dramatically higher quality of revenue.
Yeah, and that quality revenue directly impacts the profit margins, which are, expanding beautifully.
They really are.
Over the last couple of years, management executed this massive transformation plan they called Future Ready. At the time, it sounded like standard corporate jargon, but the mechanics of it are vital.
Right, they systematically trim the fat.
Exactly. Across the entire organization, they lowered their baseline operating expenses. So now, as this new wave of AI PC revenue comes accelerating in, they don't have to spend as much to support it. Those lower base costs mean the profit margins are expanding much faster than the top-line revenue itself. That's operating leverage in action.
Precisely. And management specifically pointed to better pricing as a key driver of this earnings outperformance. Because they have achieved such massive global scale, they have the leverage to push through premium pricing on this next-generation AI hardware.
And we need to be clear here.
Yeah, these new AI PCs are not the race-to-the-bottom $300 budget laptops you buy for a middle schooler. These are high-margin, premium computational devices, and enterprise buyers are more than willing to pay top dollar for that localized processing power.
But let's look under the hood financially, because higher margins don't mean much if the balance sheet is a mess. From an analytical standpoint, their financial health is rock solid. Their leverage ratio is totally manageable. But here's the mechanism that really matters right now. They have what is called a well-laddered debt maturity profile.
That is a crucial point in today's economy.
Exactly. Think of a debt ladder like having multiple mortgages on different rental properties. But instead of all your mortgages coming due at the exact same time, they expire decades apart.
Right.
In a high interest rate environment like we have today, the last thing you want is a company being forced to refinance billions of dollars of debt at suddenly terrible interest rates. Because HP spaced their debt out effectively, they heavily mitigate those refinancing risks. They aren't held hostage by current interest rates.
Which gives them the financial breathing room to aggressively defend their competitive moat. When you examine enterprise IT infrastructure, the switching costs are monumental. HP's global distribution scale, combined with their deep integration into corporate endpoint management and network security, creates a massive ecosystem lock-in. Once a Fortune 500 company standardizes its thousands of employees on HP architecture, ripping all of that out to switch vendors is a logistical nightmare.
Wait, let me stop you right there and play devil's advocate.
Yeah, go for it.
Because Dell and Lenovo also have massive distribution scale. They also have enterprise lock-in. So what stops them from just copying this exact AI hardware strategy? Why doesn't this just immediately devolve into a commoditized hardware price war, exactly like we saw back in the 2010s?
It's a totally fair question, but it comes down to execution and early mover advantage. HP hasn't just published a press release about their AI plans. They have already executed the immediate integration of Nvidia's brand new RTX Spark processors into a unified hardware portfolio.
They partnered deeply and they partnered early.
Exactly. By physically rolling these machines out to the market right now, they are capturing that highly lucrative developer and creator demographic before their rivals can even scale up equivalent workstations. They planted their flag in the premium space first, forcing everyone else to play catch-up.
And timing that market rollout is everything when it comes to predicting stock price movement. That brings us to the catalyst timeline.
The calendar for the next few months is incredibly stacked for investors. First up, in June 2026, we have Computex Taipei.
Right.
HP is actively positioning its new Nvidia RTX Spark systems as the absolute centerpiece of the entire show. This isn't just about generating tech media buzz. It's about driving tangible retail and developer pre-order data.
It's a massive visibility event.
Yeah, and it will translate into early revenue indicators. Then looking ahead to late August or early September 2026, we get the Q3 fiscal earnings. The entire financial sector will be hyper-focused on checking one specific metric.
The average selling prices, right?
Exactly, the ASPs of these AI PCs. Investors want concrete proof that these enterprise refresh cycles are materially accelerating and that HP's premium pricing power is actually holding up under market conditions.
But if we zoom out, there is a massive macroeconomic catalyst driving this entire narrative. And frankly, it is one of the most compelling parts of the thesis: the impending Windows 10 end of support.
Oh, yeah.
This is critical to understand. This isn't just a polite suggestion from Microsoft to upgrade your software. It is a hard operational deadline for enterprise IT departments.
It's a forced upgrade cycle.
Exactly. You simply cannot run unsupported operating systems in a corporate environment. If you do, you fail security compliance, and you likely void your corporate cyber insurance policies.
Which no CIO is going to risk.
Right. So every major company in the world is being forced to upgrade their hardware fleets. And as these chief information officers are forced to buy new machines anyway, they're looking at the exorbitant, unpredictable costs of running AI workloads in the cloud.
Yeah, every time an employee runs a query through a cloud AI, the company pays a compute fee.
Exactly. So to bypass those massive ongoing cloud expenses, they are choosing to buy localized AI hardware for their employees' desks. It is a dual tailwind. A legally forced upgrade cycle combined with a desperate need to cut cloud computing costs.
And layering on top of that fundamental shift, there is some fascinating, highly credible speculative chatter circulating in the buy-side community right now. Rumor has it that HP is looking to acquire a niche on-premise AI software or security platform to bundle directly with these RTX Spark workstations.
Now that would fundamentally change the math.
Completely. I mean, if they execute that acquisition, they transition from being viewed purely as a one-time hardware vendor into an AI endpoint as a service provider.
Right.
What that means is they start charging a monthly recurring subscription fee for the software running on the hardware. Wall Street loves recurring revenue.
They really do. It's predictable and highly profitable.
Exactly. Transitioning to that subscription model would force a massive upward reevaluation of the company's valuation multiples.
And speaking of valuation and market movement, the data we are seeing right now is impossible to ignore. Now let's pivot to the chart.
The technical setup here is genuinely electrifying. I mean, if you look at the charts following that Q2 earnings release, we saw a massive breakout event. Shares jumped 10.1% in the afternoon session alone.
Wow.
Yeah. And when a stock gap jumps like that, meaning it opens significantly higher than its previous close, completely breaking out of its prior trading range, it fundamentally changes the psychological technical state of the market. The stock is now trading at or near 52-week highs.
Which triggers an automatic response from certain types of funds.
Right. It creates a scenario that practically forces momentum funds, algorithms designed to just buy what is going up to chase the rally. Yeah. Furthermore, any portfolio managers who are underweight on HP, meaning they didn't hold enough of it compared to the benchmark index, suddenly have to buy in aggressively just to avoid missing out on the performance and underperforming their peers.
But it's not just the price jump, it's the sheer volume behind it. An analytical check of the tape highlights unusual volume and remarkable trading volume that put the stock among the absolute top S&P 500 gainers for the day. That is a critical insight.
Why is volume so important here?
Well, because a 10% upward move on massive expanded volume confirms heavy institutional buying. We're talking about the whales, massive asset managers, pension funds, and institutional banks.
Right, not just everyday traders.
Exactly. Retail order flow, everyday people buying 10 shares on an app simply cannot sustain that kind of massive volume surplus. It mathematically validates that Wall Street is waking up. This is a structural re-rating of the company, meaning major institutions are deciding this is no longer a slow growth legacy stock, but a high-growth AI player. When the big money moves in with that kind of force, they are building long-term positions. They aren't day trading a quick pop. They are buying in for a multi-year thesis.
Which naturally begs the question of how the broader market is interpreting this. So what does market sentiment look like?
Let's get into that.
If you aggregate the mood across the financial media and the major analysts, it is best described as cautiously bullish. The broader market is clearly beginning to price in the fundamental reality that this AI PC cycle is real.
Yeah.
The initial skepticism was completely invalidated the moment those new laptops powered by the Nvidia RTX Spark actually debuted. You can literally read the shift in how the financial media is framing the hardware sector. The narrative has shifted from a story of post-pandemic decline to a story of revitalization and growth.
However, it is not universally positive, and that is actually something we need to pay close attention to. There is still a significant wall of worry out there. For example, look at the specific sentiment coming from Bank of America. Despite the massive Q2 earnings beat and the revenue acceleration, they sent a notoriously tough message to their clients.
Yeah, valid.
They explicitly stated that they are not ready to call it a clean turnaround and are maintaining a highly mixed, bordering on bearish posture on the stock.
I understand why that sounds alarming, but from a thesis-driven perspective, that skepticism is actually a brilliant contrarian indicator.
How so?
Think about it. If every single analyst on Wall Street was already pounding the table and issuing strong buy ratings, there would be no one left to buy the stock. It would be priced to perfection.
Right, exactly.
But if major analysts like Bank of America are still dragging their feet and refusing to admit the turnaround is real, it leaves a tremendous amount of runway for future analyst upgrades.
I see.
Yeah, as HP continues to execute over the next 2 or 3 quarters, those bearish analysts will eventually be forced to upgrade their price targets just to catch up to the reality of the earnings. When they finally do issue those upgrades, it creates a secondary wave of buying pressure down the road.
That makes sense, but we can't ignore the very real operational hurdles they're facing. Now let's talk about the risks.
Because as much as the momentum looks unstoppable, there's a severe primary threat here, right?
Yes, and it is component inflation. Recent supply chain data is definitively showing that the memory shortage is just beginning. Prices for essential PC memory components, specifically DRAM, are spiking aggressively.
Yeah.
You have to remember, hardware is ultimately a margin game. It's the difference between what it costs to build the machine and what you can sell it for. If the raw materials, like memory chips, suddenly cost vastly more, it poses a severe risk to gross margins. If that component inflation outpaces HP's ability to raise the final retail price on their PCs, the entire margin expansion narrative we just talked about completely collapses. You could easily see a scenario where top-line revenue is going up, but actual profits are getting squeezed to nothing.
That is undeniably the biggest headwind, but let's look at the mechanics of how HP mitigates that.
Okay.
First, because they're massive global scale, they receive preferential supplier allocation. When memory gets tight globally, the companies buying millions of units get to skip to the front of the line and lock in the best bulk rates.
Right.
Second, the premium nature of these new AI devices provides a much thicker financial buffer.
Walk us through that math.
Sure. So if a global shortage means a memory module suddenly costs an extra $30 to procure, trying to absorb that unexpected cost on a cheap $300 budget laptop destroys your profit margin entirely. But if you were selling a $3,000 high-margin AI workstation to an enterprise developer, absorbing that $30 hit is barely a rounding error. The transition to a premium product mix fundamentally protects their margins from supply chain shocks.
That's a great point. There is also an execution risk tied directly to that Bank of America skepticism we mentioned earlier. There is a deep-seated historical fear on Wall Street that PC demand is inherently cyclical.
Yeah.
A boom is always followed by a bust. The risk here is what happens if this initial wave of AI hardware upgrades cools off?
Wow.
What if early adopters and enterprise IT departments buy all their new machines in 2026, and then by 2027 demand dries up and the market is a ghost town again?
That is exactly why we spent so much time on the wealth building context at the beginning. HP's incredibly strong free cash flow, the share buybacks, and that consistent dividend provide a valuation floor.
Right.
Because Wall Street has historically treated HP as a legacy hardware company, the stock isn't trading at some astronomical nosebleed valuation multiple. It isn't priced for absolute perfection. Even if demand eventually stabilizes into a more normal cyclical pattern after this initial supercycle, the aggressive capital return strategy ensures a robust total return for investors while limiting the downside.
So with everything on the table, what's the final verdict?
The final verdict here is a highly confident bullish score of 8 out of 10.
Okay.
The core thesis is straightforward. HP is currently the premier tactical vehicle to play the localized AI PC supercycle. It provides the explosive upside of the artificial intelligence infrastructure build-out, but because of its massive free cash flow, it offers a highly asymmetric risk-to-reward profile.
Right.
Your downside is protected by aggressive capital returns, while your upside is exposed to a massive technological shift.
And regarding the target horizon, we are viewing this as a solid 12 to 18-month hold. That specific timeline is entirely deliberate.
Yeah.
First, it fully captures the impending Windows 10 end-of-support deadline, which will force the enterprise refresh cycle. Second, it allows enough time for the revenue from the new Nvidia RTX Spark integration to fully hit the trailing 12-month financials.
Meaning a full year of validated high-margin sales will officially be on the books.
Exactly. Once that hard data is public, it will likely force the remaining bearish analysts to finally capitulate, upgrade the stock, and drive the next major leg up in the price.
Makes perfect sense.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Ultimately, the personal computer isn't a dying relic of the past. It's just getting a massive brain transplant. And the companies providing the operating table are poised for an incredibly fascinating run. But here's a thought to leave you with. If localized AI on these premium devices becomes powerful enough to replace cloud computing entirely for daily tasks, what does that mean for the trillion-dollar valuations of the major cloud providers next year? Keep an eye on those margins, and we'll keep tracking the data.